Now, we continue to talk about that inflation report because it did change expectations for rates. We've also got a federal election coming up. So how's that going to impact the housing market going forward? Our national obsession. Anthony Landahl from Equilibria Finance is joining us for his thoughts. Anthony, good to see you there. I have to ask, do you now believe that the RBA will hike in this election cycle next month? Perhaps you already thought it would be brave enough to do so.
Yeah, g'day Nadine, and I think I've been asked that question more times in the last 24 hours than over the last 6 months. It is a red hot topic. Look, I think the question is a 0.1% cash rate still appropriate in the current environment? And I think the answer clearly from all commentators, from the data we're seeing, cost of living pressures is no. My feeling though is that the RBA will hold until June for a number of reasons, including the political environment and the election is coming up. But separate from that, maintaining their independence, I believe they're going to wait to see the wage index on the 18th of May because their main concern has been the cost of living pressures, which are now, as we can see with inflation, getting ahead of where their forecasts were. But I believe they're going to hold off till June, and at that point we might look at maybe a 40 basis point jump or something like that, just waiting for the wage price index to come out and see what's happening. But the big risk is, which we're all commentating on, is that inflation's getting out of control and getting beyond just those supply chain issues into more common day-to-day expenses. The inflationary numbers for groceries, for example, and petrol's at about 6.6%. So genuine concerns. The RBA's in a little bit of a rock and a hard place now. They've hung tight, and then inflation's just got away from them for a number of reasons that have been outside of our control, as much as now domestically and internally coming into to bite us. But if you ask me straight, I think they're going to hold out till June, and I think we'll probably see a larger rise in June of maybe 25 or 40 basis points. An interesting statistic, actually, just looking into it in the last day or two, is that the last time the RBA increased rates was by 25 basis points in November 2010 to 4.75%. So we've been in an extraordinarily unique environment for quite a long time, and we've had 75 basis points drop since COVID.
Now, Anthony, can I read into the fact that you've been asked about the RBA and its rate hike cycle, so much in the last 24 hours, is that you might be speaking with people, your client base. Are they getting nervous?
It's an interesting environment. I think we've got to separate owner-occupiers and investors. They're looking at this through a different lens. For an owner-occupier, it's very much their mortgages are in a sense a cost of living. It's their home, and on a $600,000 loan, they might be looking at, with a 25 basis point rise, they might be looking at $50 a month, and that adds up over time. And a lot of mortgage holders have not seen a rate rise for at all, and they've bought in an environment of the market running away in low rates. We've had a lot of discussion with clients about whether they should fix, but that's already been priced into the market. So for an owner-occupier, there's genuine recalibrating around budgets and affordability, bearing in mind their conversations we've had with a lot of clients over the last 12 or 18 months around letting them understand, if rates rise, what their repayments are and what that looks like. But the rubber's now starting to hit the road. But an investor's looking at this through a different lens. They're seeing prices potentially dropping 5 to 15% over the next 12 months. They're seeing a market where a lot of investors sold and made a good gain in recent times, but they sold to owner-occupiers. We've got a shortage of rentals, so we've got increasing yields. And for the investor, that's essentially a bit of a buffer against the rising inflation. And for them, we've got increasing yields, and for them the cost of money is still relatively cheap for their investment. So we've certainly got a different approach from investors, and we're seeing a lot more investor activity looking for opportunities to capture while prices are dropping, and then they're looking at the market running again in about 2024.
Now, when you think about where the strength will continue to come through in the investor portion of the market. Is that for is that for homes? Is that for apartments? Are you looking urban versus regional?
Yeah, what we're seeing is a lot of the regional markets are holding up, and we're also seeing some growth in Brisbane and Adelaide that maybe there's still some opportunities there. They didn't see as big a run on the market as some of the other capital cities over the last couple of years, but it's very much region by region. The regionals, we're seeing housing. Adelaide, Brisbane, we're seeing houses, but we're getting some demand back in for the units in some of the capital cities. Sydney and Melbourne, with the borders opening up again, we're starting to see investors come back into units because the market really did soften through COVID for investors. They really did sit on the sidelines, particularly with units through that time. Regions are still popular, but we've had a lot of growth in the regions. So some of those areas the investors are seeing, they might be buying at their peak. But regional areas, Brisbane, Adelaide, we've got some strength there's still some opportunities there, and units are coming back in Sydney and Melbourne particularly.
Now, Anthony, just final question. I just note at the top of news.com.au, we've got the former Prime Minister John Howard saying that there is no housing crisis. He doesn't accept there's a housing crisis with the costs rising. We'll leave that there, but I do know that we usually see a bit of a slowdown in activity through election cycles. Is that coming to fruition this time around?
Yeah, I think there's a sort of confluence of factors. I'd probably in general agree with our former PM there that the market, I think, is going to maintain strength. We're just going to get a bit of a correction. As I said, it might slow down 5 to 15%. That's on the back of a 20%, 22% growth. So that will correct itself and is. Yes, it has slowed a little bit. I think that's a few factors. I think there's affordability issues, absolutely, for owner-occupiers still. There is a bit of uncertainty about rates. There's the election coming on. And there's a little bit of a wait and see. There's some buyers now sitting on the sidelines going, you know what, I think the market might drop a little bit over the 6 months. I'm just going to wait to see what happens. We are seeing that, but what we are also seeing is investors now coming in and picking up those opportunities with some negotiating power at the table that probably didn't exist 6 months ago.